Good day, everyone. I'm Ronald, the moderator for this webinar. I welcome everyone for today's webinar that is on problem asset management, identification, management, and resolution. I would now like to introduce our presenter for today, Dave Stryszek, a frequent speaker, instructor, advisor, and writer on credit risk and commercial banking topics and issues. I would now like to hand over the floor to the speaker. Over to you, Dave.
Thank you, Ronald, and welcome to all of you who probably are listening or watching this problem asset management session because you probably have noticed that there's been a little pickup in problem loans. But what we're going to be doing today is working our way through what exactly problem asset management is, the role of credit culture, and then some tips, techniques for mitigating problem loans. So let's start first with the introduction. Now, let me explain that this really is based on the idea that if you move quickly enough, a small problem loan is a lot more easier to manage than if you let it go and it grows into a much bigger problem. Why do credits go bad? Well, essentially, one of the problems of a business cycle is that as the cycle expands, people start looking for more and more deals. Production sometimes blinds lenders and creditors, and we start taking risks that we might not have taken on earlier in the cycle. And one way to kind of get in the preventive maintenance frame of mind is to think about credit risk. So credit risk basically is all about the chances that your borrower may not be able to repay you in full, on time, and as agreed. Basically overlaps other risks. Think about a PRAC as an early on step to prevent new faulty products from attracting customers who might not be able to pay you back. Lots of words have been written, speeches made about the importance of credit culture. But if I were to sum it up in a few words, I would grab at the how we do things around here. One of the payoffs of a good credit culture is, of course, having a good credit risk management. What we want to think about is, well, how do we set up a good credit risk management that supports a sound credit culture? So in a values-driven culture, what you care about is a long-term consistent performance. The optimal credit culture then is where top management sets asset quality as a priority. Line and credit are holding hands. So a weak credit culture really leads to problem loans. With all of that, when we look at the 14 credit discipline tools, take a look at your bank, and hopefully the answers to all 14 of these are yes. If not, you've got something to work on. Credit cultures relying on risk management predict. What we want to try and find are indicators that pop up soon enough, far enough ahead of potential problem loans. So as I mentioned earlier, transactional risk, too many risky borrowers, too much risky type of lending, our concentrations, we need to get those under control. So we measure risky borrowers by looking at the risk rating system. We pay attention to lines of business or products that we can either measure percentage of the portfolio or by the risk scores. The most serious situation is when you have all three as too much. And a little bit of concentration is usually resolved by dealing a little more in participations with other banks that get you outside of your particular geographic area. There's is another slide that deals with risky how to curtail that risk. So credit policy. The idea of policy is really to write down the rules by which the credit culture and credit risk management are going to operate. So a little more on policy exceptions and doc exceptions. Some banks have dozens of policy exceptions. The policy exceptions usually break into two groups. Those on the transaction, like do I have a guarantor? What about the loan to value? Or the obligor, where you've got a borrower who doesn't have enough debt service or doesn't give you up-to-date financials. The idea is that you want to track these. Generally, it is the role of the lender or perhaps the credit department to identify policy exceptions as they go through the approval process. They are recognized. Legally enforceable loan docs. A doc exception occurs when, one, you don't have the document. Two, you have the document, but it's incomplete. They forgot to sign it, for example. Risk ratings themselves. One rule of thumb is that if you've got more than 30% of your loans in any one rating, you don't have enough ratings. The idea is to sort of spread it out. So this diagram simply gives you an opportunity to see the math behind estimate of loss. And this particular slide simply points out what I had said earlier. The smaller the borrower, the bigger the probability of default, and the longer you go out, the larger the probability of default. So when we get to risk rating, it's all about, how did we structure it in terms of repayment ability versus cash flow, collateral, and guarantees. And so more and more banks are switching to a two-dimensional risk rating system in which we rate the borrower, the obligor, and then we rate the facility rating. We also need to make sure that we take into account the collateral, the guarantees, and the cash flow. So when you set up a risk rating system, ideally, you've got two pass grades below average. Otherwise, you don't really have an average. Remember, we're really trying to follow a preventive maintenance, set the rules now, and then you ward off the problems later. Probability of default is really about, again, measuring the ability of the borrower to repay, which means you have to pay attention to the stability, the volatility of the cash flow. Cushions of protection is another way of describing, again, collateral guarantors. Timeliness is also important. There's a tendency for risk ratings to kind of get sticky. The stickiness really, here are a couple of examples on timely risk rating. So special mention is interesting because it's sort of a neither fish nor fowl. It's a potential weaknesses, problem asset management itself. First key here is problem loans should be shifted immediately once they're substandard to your problem asset workout area. Business decline, take a look at a chart or a graph of the sales. If they peaked and started declining, you also have linkages. So there's lots of reasons for failure. Basically, it's all about management not making it. Either inexperience or incompetence makes up the vast majority of it. Another thing to keep in mind is what I'll call the crib death factor. There's lots of failure predictors out there. Altman Z-score came out in the late 60s. And when we look at identification, it kind of falls into four categories: financial, management, operations, and banking. So the financial is the one bankers are probably most comfortable with. More, if you're interested in that, I talk about this is a sustainable growth rate formula. Many banks rely on EBITDA and EBITDAR. When it comes to management, here's a grid of red flags. And there's fraud. And so the problem with fraud is a crook's unlikely to use an accurate valid Social Security number. Fraud prevention, there's an association of certified fraud examiners out there. Another tip might be that if you've got a borrower who has undergone a fraud, sit down with them and suggest that they put this action plan in place, points 1 through 7. So operations, this is really seeing is believing, and knowing the business. Are a independent church whose bishop was not a very nice person. Or here's an example of a site situation. So banking, we often ignore stuff like the depositor experience, tendency to lighten up to attract more customers. We're very timid. We don't lay down the law, and of course, failing to monitor So it's important that you move it over to problem assets. And a key element in that would be the checklist. Can the borrower really survive? Again, rehab or exit. Outplacement, in order to have a workout, you really need to figure out whether the borrower will be able to repay you ultimately. And if the borrower is cooperative and the borrower is uncooperative, forget about it. This was going to likely involve face-to-face meetings, a confirmation letter, and then avoiding lender liability. You need to manage this. Remember, your ALLL needs to be big enough to take care of your potential loan loss reserves. Now that we have current expected credit loss, remember the challenge here is that you have to project from the inception of a loan. The other challenge is that CECL requires a lot more information. I've gone through this fairly quickly. There's lots of information tucked in here. All right, well, thank you. I've given you a number of tips, but I think if you start with my list of 14 credit discipline tools, that's a good start to assessing what you need to have in place in order to be able to have an effective preventive maintenance program for problem loans. With that, I'll stop talking and drop off. Thank you very much.
Thank you, Dave. That does conclude the session for today. Thank you everyone for participating. You may all disconnect now. Have a great day ahead.